Last week, we spoke about the impact of inflation on your practice. I shared that inflationary pressures are exacerbated for those of you who accept plans because you have virtually no upward pricing capability. And I shared with you that this significant challenge is largely whitewashed because most of you use cash basis accounting. This week, I'd like to share with you a businessman's primer on the difference and impact of cash versus accrual accounting. Cash basis accounting is just that. One accounts for things when the cash comes in and when the cash goes out. It's simple. On the other hand, accrual accounting is based on incurrence. One accounts for transactions when one incurs it, whether revenue or cost. Further, accrual accounting uses a balance sheet to ensure accuracy and to tell you where your assets and liabilities lie. Accrual accounting is a bit more complex than cash accounting, but it's much more accurate and eliminates a great deal of mystery. Let's look at why. Mr. Smith comes in on the 28th of April and secures a $75 vision plan for exam for which your usual and customary fee is $150. There's a $20 copay. He also purchases a $300 pair of eyewear for which you're reimbursed $150 by his vision plan. The frame this patient chose was purchased by your practice back in November. With cash accounting, your frame costs of goods would have been booked in the month after you actually purchased it when you paid your vendor statement, with no associated revenue. In this example, that cost would actually have been accounted for last year. Your income statement would show $95 in revenue for April with no associated cost of goods. In May, when the lenses are received and delivered, you'll have labor costs but no associated product costs because you pay in June. As for your vision plan reimbursement, you'll receive that in June for May business. Worse is when that insurance claim is rejected. Your monies are hung up in receivables for which many of you have few controls. For this one transaction, the revenue and associated costs are actually spread out over 4 different months and 2 different years because the accounting is booked when you receive the monies or pay them out. The revenue and the associated costs have virtually no connection. The result is that your financials are actually deceiving. Cost of goods isn't cost of goods, it's cost of purchases. Revenue isn't revenue, it's collections. At best, in a business with inventory and accounts receivable, cash accounting provides a hot mess and very little beneficial information. Yes, you know what you paid for and what you received in any given month, and you certainly know your checkbook balance. But as my example showed, there's no connection between revenue and costs. Because of this, costs can rise from inflation, and it will be months before you see the impact on your financial statements, if at all. With accrual accounting, you book revenue and the associated costs when they're incurred. Your product purchases aren't booked as a cost, but as an inventory asset, a balance sheet transaction. The cost is booked only when you sell the product. As a result, your costs are aligned with your revenue. Further, both what you owe and what you are owed is accurately tracked. Vision plan write-offs are tracked because revenue is booked as usual and customary, with vision plan write-offs being credited against that number. You'll know the true impact of vision plan write-offs on a monthly basis. In simple terms, accrual accounting provides the only accurate picture of the true performance of your practice. So why is this important? In the simplest of terms, it's because having tight financial controls, including a balance sheet that balances, is critical to good business management, especially in inflationary times. In optometry's case, the potential higher cost of inventory replacement should be factored into your pricing. Further, having a clear understanding of your accounts receivable and vision plan write-offs is mission critical. Do you even know how much you write off for vision plans? Would it surprise you that the average Cleinman client takes a $236 hit for a vision plan patient, more than the cost of the eye exam that brought them in the door? Said another way, you could give your eye exam away for free and make more money. Good financial management is at the heart of every successful business. In today's inflationary and vision plan dominated environment, having a clear understanding of the connection between costs and revenue, combined with control over payables and receivables, is mission critical. Only accrual accounting delivers the information you need to make good business decisions. Cash accounting is the equivalent of management by checkbook balance, a prescription for underperformance.